Our first guest today, I want to bring in Simeon Siegel, BMO Managing Director here, who has a price target of $20 on Under Armour with a market perform rating. And Simeon, I mean, we're talking a top and bottom line beat up in forecasts here. As Emily is pointing out, though, still sounds like investors might be digesting what growth looks like ahead. So what do you make of where Under Armour sits after what on paper looks like an impressive quarter?
Yeah, and listen, it was an impressive quarter, and thanks for having me. I think the fascinating part here is that we just got off. You were talking about Pfizer; they're completely interconnected, right? Here, there's reopening trades, and retail is the biggest beneficiary. So, Under Armour, had we spoken about this a year ago, Under Armour's story has so drastically improved. This is a company that took the pandemic, took advantage, and reshaped who they wanted to be. Now, what that meant was internalizing that they had stretched too far in the past. So now where we are, we're in this amazing profit opportunity. The revenue is going to come under question. But I think what's really important to acknowledge is you just cited that fact set point. Who doesn't know there are going to be beats? The stocks have reflected a lot of this. Across my coverage, just looking at first quarter retail reporters, revenues versus 1Q19, so 2 years ago, are up over 20% on average. The stocks are flat. So I think there's that dichotomy here of I wouldn't necessarily look at the stock movement as an indication that the quarter was not strong. This is a great start to a year after a very impressive year behind us. And I think that's going to continue.
And Simeon, to that point, retailers across the board, as you mentioned, are rebounding as vaccinations take place. People are looking to revamp their wardrobes. But where Under Armour fits in all this, do you see it growing faster, as fast as, or slower than the average retailer?
So listen, I like letting numbers answer for me when they can. Under Armour right now on that 2-year basis, just to be perfectly fair, did grow slower than that average. So if we're seeing an average of a 2-year 20% growth rate, Under Armour's is mid to high single digits right now. So there's going to be these interesting ways to compare and to think about where we're going. But I don't mean that in a negative way for Under Armour. I don't think that means that Under Armour is lacking. I think it's an acknowledgement that Under Armour had already become one of the largest brands in the history of time. Brands can only grow so far. So I think what has been so impressive about management's focus is that they've acknowledged that they got to a certain point in their revenue base that perhaps wasn't as healthy as it should have been. They look back, they focused on quality sales, which honestly means giving up some revenues. And what they're seeing is meaningful margin growth. And the important part is when you're not making money in the first place, margin rate growth actually means more dollars. So you're seeing op income dollars that are growing even as revenues are lighter than the rest of the group. So yes, I actually do think this is going to be a year where we're on a 2-year basis. Under Armour lags from a revenue perspective, but I think their margin trajectory, that rubber band, is incredibly powerful.
Yeah, when it comes to your first point there in terms of earnings expectations and beating it, I wonder how Under Armour fits in kind of in that apparel sector competition, right? Over the last 5 years, the stock's down about 50%. In the last year, though, it's outperformed Nike. So I'd be curious to see where you put this in terms of how the market's valuing the growth that Under Armour could have. Keep in mind, they're also still kind of undergoing this management transformation, if you want to call it that. They also disclosed they're going to be paying a $9 million fine tied to some of their filing issues with the SEC earlier on. So, I mean, how do you put that management piece in this recovery and pair it with competition from Nike?
Yeah, I think management's doing a nice job. I think every change that we saw last year was obviously triggered by management. And even the SEC comment that you're referencing is dealing with an issue from the past. So I think that what we are seeing, there were a handful of companies that recognized the pandemic gave them a hopefully once in a lifetime opportunity to completely change their game, to completely revisit how they approach their business. And you saw Under Armour last year make several $100 million changes, right? Which in theory are several $100 million admissions of mistakes, but they're also acknowledgments that they can do differently in the future. And that's looking at the Fifth Avenue flagship that they had planned. That's thinking about the way they've changed their endorsement structure. They had a restructuring plan. So I think you've watched management already leave their mark. I think going forward, it's going to be a continuation of what they've put in place. But I do think we're always going to be met with this balance. And this is not specifically Under Armour. It just happens to be that they are one of the largest. Growth for growth's sake versus profits, and how big at what point is less can be more. And again, I think Under Armour was one of the absolute best companies last year to recognize that the pandemic was going to change everything. And we've said that COVID may have actually saved retail. I think Under Armour was one that grabbed that bull by the horns early on.
And Simeon, when we look geographically, of course, Under Armour just blowing expectations out of the park when it comes to Asia Pacific sales, North American sales lagging, growing not quite as quickly there. What's working in that geography that's not working in North America for Under Armour?
Yeah, it's a great point. And I think that generally speaking, Asia has represented obviously the early arc of recovery that we've been watching. So if we think about geographically from the pandemic, it's been Asia got hurt first, then the US, then Europe, and we're seeing the recovery in that frame of reference as well. For Under Armour in North America, again, I think it's important to contextualize less that they weren't doing well, more that they got so large. I mean, the reality is it got to a point where Under Armour was the hoodie you would see walking through Disney World, even as they said they were meant to be on court, make you better. So there's a question of, at the end of the day, when does the incremental customer become a detrimental customer? When does too many revenues actually hurt your profits? And they are a case study, right? I think that they went too far. They would acknowledge that. And now they're working on coming back. So that process of recalibrating North America is going to look different for them. Success for Under Armour in North America will look different than success for a much smaller business in North America, because Under Armour needs to make smaller, tighter, healthier. Other businesses, we normally measure success much easier. It's how much revenue you're growing. So I think that that's going to be this interesting cognitive dissonance that we're going to have to acknowledge and work with. And I think Under Armour is going to show us that. And one way, and you mentioned it, one way that we're seeing it is the growth of DTC, of stores and e-com, rather than wholesale. And the back half of this year is going to be very focused on pulling back on the undifferentiated partners, similar to your point, as Nike had said they were going to do, as they tighten up and elevate their brand.
All right, Simeon Siegel, BMO Managing Director. Appreciate you coming on here to chat that with us. Be well.